Hi, welcome to this video. In this video we will discuss funding in the Dutch market. What will be the items for this video? First of all, we'll discuss different types of funders. That's banking funding, securitization, covered bonds, and mortgage funds. So you will have a brief overview of the different type of funding vehicles in our market. There's a variety of lenders in the Dutch market, all using different types of funding. And of course there are banks, and a bank has a banking license. And banks have banking license because they have money of consumers. They have their savings, and they use the savings of the consumers to originate mortgages. But we also have lending platforms, regiepartijen, in our market, and they offering mortgages to consumers with money from external investors. So a lending platform is the bank. They don't have a balance sheet, but they are more or less playing for lender. And what we also see is that some lenders, they have what we call a multi-funding strategy. So they don't use one strategy, they don't use one type of funding, but they use more type of funding. The four types we have in the Dutch markets are balance sheet funding, and the balance sheet is the balance sheet of the bank. Securitizations, that's a set of mortgages packed in a package and transformed into bonds, and the bonds are sold to investors. We have covered bonds, that's something a bank can do, and we have mortgage funds, and that's for institutional investors, often done by a platform. And here you have an overview of different lenders in the Dutch market, and you can see which type of funding, which source of funding is used by what lender. And there are lenders who are operating on one type of lender, for instance Triodos Bank, only balance sheet funding, but in the middle you see, for instance, NIBC Direct, and they use and their balance sheet, and they use mortgage funds, and they have securitizations. So this gives a nice overview of what is happening on the funding side of the market. And let's now go quickly through those four types of funding. First of all, balance sheet funding. And here you see a balance of a mortgage bank. The mortgages are the assets of the bank, and the savings or loans of other banks are the liabilities. So, for instance, the bank receives savings from consumers, and they use that money to originate mortgages and to give consumers a mortgage loan. If you look at the different aspects, first of all, the consumer, he gets a mortgage from the bank to buy a house, but the same consumers, maybe it's a different person, is putting his savings in the bank, and with that money the mortgages are granted. If you look at the interest which is paid on the mortgage, first of all, it's used to pay interest on the funding. However, the current interest rate for savings in the Netherlands is around 0, and we are expecting that we have negative interest on savings. So that's not very expensive funding. Of course, we need to pay the operational cost of the mortgage, and we have to pay the risk costs. Last but not least, we have to pay what we call capital costs. A bank has to retain financial buffers, equity. The equity is from the owners of the bank, the shareholders, and the shareholders, they want to have a return. So that's what we call the capital cost and the profits. And of course, there are risks for the bank. Risk because they are in the mortgage business. And it's the credit risk, it's the interest risk, the operational risk, and the liquidity risk. So all the 4 risk types from the mortgage business stay with the bank. But suppose that the lender wants to sell a package of mortgages to an institutional investor and he wants to use a securitization. For the securitization, a new entity is created and we call it an SPV, a special purpose vehicle. And a section of the mortgage book is sold to the SPV. And to be able to buy the mortgages, the SPV has to collect money. And they collect money by issuing bonds. And it's not one type of bond, but several types of bonds. We call it tranches. And there are AAA bonds and AA bonds and single A bonds, maybe triple B bonds. And those bonds are bought by institutional investors. So with a securitization, a lender can, let's say, sell his mortgages to an investor, but through an SPV, and they use the bonds as the technical instrument. So the lender will originate the mortgages, and when the pool of mortgages is full, it's sold to the SPV. And then the SPV is issuing the bonds in tranches, and those are bought by the investor. And the investor will receive the cash flow from the mortgage pool. Not all the money, because the lender probably wants to have a fee, because the lender is managing and servicing the mortgage pool. Which risks stay at the lender? The operational risk stays at the lender. What I said, the lender will do the administration, he will receive a fee, but because he is doing the admin, the operational risk stays at the lender. He has the pipeline risk, because the origination, that's the responsibility for the lender, and the SPV will buy mortgages which has been originated, so there is no pipeline risk anymore. And partly the liquidity risk stays at the lender, because at the end of the SPV, at a certain time, the mortgages will go back to the lender. The risk for the bondholders are the credit risk and that's important, the prepayment risk on the mortgage pool. Another way of issuing bonds is using the covered bond. And a covered bond is created in a subsidiary of a large bank. And a covered bond is always a AAA bond. So the subsidiary issues bonds, they sell them to institutional investors, and that money is used to originate mortgages. And the origination is done by another subsidiary of a large bank. So if we consolidate both companies, it looks like this. Mortgages as assets and bonds as liabilities. But the covered bond company is not a normal company, it's a special company. And it's a special company because in case of bankruptcy, the covered bond company will not go in the bankruptcy but stays separate. And what we'll see is that the covered bonds are connected with a part of the mortgage pool, and that pool is pledged to the covered bond company. So the bondholders get the mortgages in case of bankruptcy of the bank, and you understand that's a very good security for the bondholders. Important to understand is the mortgages stay under normal condition just on the balance sheet. So the bank has all the risks which are comparable to balance sheet funding. There's nothing going to the bondholder. The pools of covered bonds are flexible. You can issue more bonds if you have more mortgages. And what I said, the covered bond company is a solvency remote entity. It will not go into bankruptcy if the bank goes bankrupt. Covered bonds are often used because of their AAA rating as collateral for a loan at the ECB. And the last form of funding is the mortgage fund. Again, institutional investors like pension funds, they are the owner of, for instance, this pension fund. And the pension fund wants to originate mortgages. And they don't do it themselves, but they use a lending platform. And the lending platform is more or less playing for mortgage bank. They do the distribution, they do the underwriting and the origination, and they are responsible for the servicing. So the institutional investor is only interested in, let's say, the financial asset and not in the rest. How does that work? A pension fund gives what we call a mandate of, let's say, €500 million or €1 billion to a lending platform. The lending platform is originating mortgages for that amount, and those mortgages are placed in the mortgage fund, and the institutional investor is fully owner of the mortgage fund. So the mortgage fund will be consolidated for 100% into the institutional investor. So the platform will originate the mortgages, the investor will provide the mandate, and the lending platform doesn't have the mortgages on the balance sheet, and there are no bank. The interest which is paid on the mortgages go to the investors, but there is a fee for the lending platform. So running a lending platform is fee business and not interest margin. And it's a fee for primary and special servicing, and often for asset management, the fund itself. The risks for the mortgage fund are interest risk, credit risk, and operational risk. So, in summary, what did we have learned in this video? There are different types of funding in the Dutch market, and it's depending on the funder which type is favorite. And several lenders, they use what we call a multi-funding strategy, and they use more types of funding. If you go into more detail, there is a lot of technical stuff, and if you're interested, please follow one of our online seminars. It's also interesting to look at some other modules, for instance, the Introduction to Risk Management or the Dutch housing and mortgage market. I hope to see you soon in one of the sessions, and good luck with all the self-study.